Welcome to this explainer on the new IFRS 18 standards. Look, if you're a financial reporting manager, an accounting pro, or sitting on an executive board, you are absolutely in the right place. Today, we're unpacking how financial reporting is getting a massive, and I mean mandatory, structural upgrade. We're talking about a complete top-to-bottom overhaul of the statement of profit or loss. IFRS 18 is officially replacing the old rules and ushering in a completely new era of strict organization. So let's just dive right into it. Okay, let's start by contrasting the old with the new. The old IFRS 1 rules gave companies a lot of flexibility, which sounded great, right? But in practice, that flexibility often led to wildly inconsistent subtotals. One company's operating profit could mean something completely different from its biggest competitors. It was a nightmare for investors trying to compare them. The new IFRS 18, on the other hand, introduces strict, mandatory categories in rigidly defined subtotals. Think of it as the ultimate financial organizer, making sure statements are highly comparable across the board. Here's a quick look at our agenda for this explainer. We'll hit the executive summary, the 5 mandatory categories, dive into main business activities, show you the flow for calculating operating profit, discuss the investor impact, and wrap up with a transition checklist and FAQs. Right, Section 1, Executive Summary. The ultimate organizer. So what is the driving force behind this? As IFRS 18, paragraph 1 clearly states, the fundamental objective here is faithful representation. The folks at the International Accounting Standards Board basically realized that to faithfully represent a company's true economic reality, they had to eliminate all that historical inconsistency. This standard literally forces a structured summary so that peer-to-peer comparisons become effortless for the stock market. No more hiding operational costs in obscure, vague line items. Moving on to Section 2, the 5 mandatory categories, sorting the household. I absolutely love this analogy because it makes it so simple. Just like separating your personal household chores and finances, IFRS 18 requires you to sort every single piece of income and expense into one of 5 mandatory buckets. Think of the operating category as your groceries, your daily running costs. Investing is like income from a side rental property. Financing, that's your mortgage, the cost of actually raising capital. Income taxes are just like your property taxes, and discontinued operations is like the massive one-off event of selling the house entirely. Every line item has to find a home in one of these 5 buckets, no exceptions. Now, the crucial point you really need to take away here is that the operating category acts as the default bucket. It's the catch-all. If an item doesn't explicitly meet the strict, rigid definitions for investing, financing, income taxes, or discontinued operations, boom, it automatically lands in the operating bucket. This means even highly volatile or non-recurring items go straight into your operating profit if they don't cleanly fit into the other 4. Section 3, Main Business Activities. And here is where we get the plot twist. Let's look at how the main business activity rule applies in the real world. Take interest income. For a standard manufacturing company, interest income goes into the investing bucket, and interest expense goes into financing. Makes sense, right? But wait, what if you're a retail bank? Well, if you provide financing to customers for a living, money is your groceries. It is your daily operation. Therefore, those exact same interest line items jump directly into your operating bucket. Your main business activity literally dictates how you define your operating buckets. So for the accounting staff down in the trenches trying to classify these items and distinguish between investing and operating assets, here's your checklist. Ask yourself, 1. Do you invest in assets as a primary business model, like an investment property firm? 2. Do you provide financing to customers, kind of like a bank or a dealership offering auto loans? And 3, do you use subtotals of these activities as internal performance indicators? If the answer is yes, you've got a specified main business activity on your hands, and you have to shift those relevant investing or financing items straight into the operating category. All right, Section 4, Calculating Operating Profit, the visual flow. IFRS 18 actually mandates this exact step-by-step calculation flow. Step 1 is calculating your operating profit, which, remember, includes everything in that default catch-all bucket. Step 2 adds your investing category to get your profit before financing and income taxes. And finally, Step 3 brings in your financing and taxes to arrive at your bottom line profit or loss. Because of this rigid structural logic, every single company is going to stack up their subtotals in the exact same visual flow. Section 5, Investor Impact, Upgrading Valuation. Up until now, management teams absolutely loved using their own custom metrics and press releases. Things like adjusted EBITDA, which, let's be honest, weren't always transparent in the financial statements. Well, IFRS 18 officially defines these as management-defined performance measures, or MPMs.
The new standard forces companies to include these MPMs in a single, dedicated note within the financial statements. And here's the kicker. They must explicitly reconcile these custom metrics directly back to the standard IFRS subtotals we just talked about. You have to show your math.
These changes are a huge win for investors. They finally get true subtotal consistency across peers. It's a real apples-to-apples comparison now. The transparency of those MPN reconciliations means management can't just hide behind custom, adjusted numbers anymore. Plus, getting a clear separation of operating versus financing assets drastically improves the accuracy of stock market analysis. It just leads to much more predictable and reliable valuation models over time.
Section 6. Transition, Checklist, and FAQs. Let's cover the practical stuff.
A massive challenge during this transition is figuring out what to do with foreign exchange or FX differences. Literally every global finance team is pulling their hair out asking this question right now. Well, here's your answer straight from the standard. You must sort FX differences into the exact same bucket as the underlying item. Simple as that. So if a foreign currency debt instrument creates an FX difference, and that debt lives in your financing bucket, the FX difference goes into the financing bucket too. But if doing this requires undue cost or effort, IFRS 18 gives you an out, a practical expedient. Those hard-to-track differences just default straight into the operating category. Okay, here's another frequent, kind of tricky question, especially for lending institutions. What happens when your cash and cash equivalents are pooled, and you just cannot distinguish which portion is used for providing customer financing versus, say, general corporate purposes? The standard doesn't mess around here. If you can't separate them, you can't just guess. IFRS 18 requires you to default all of the income and expenses from those indistinguishable cash equivalents straight into the operating category. It's all about maintaining reporting consistency and absolutely preventing any cherry picking. To make sure you're fully compliant, your management team really needs to follow this disclosure checklist. First, you have to officially identify and disclose those main business activities. Second, you need a documented accounting policy for how you handle cash and liability classifications. Third, if your assessment of your main business activity changes over time, you have to disclose that change. And finally, you absolutely must prepare that all-important single note reconciling your management-defined performance measures.
Paragraph 43 really hits the nail on the head regarding the spirit of IFRS 18. Ultimately, this whole structural overhaul isn't just about moving numbers around on a spreadsheet to keep regulators happy. It's about delivering a faithful, unobscured representation of your company's true economic reality. It's so that the users actually understand the item they're looking at. So, as you guide your team through this major transition and start sorting your accounts into these new mandatory buckets, I want to leave you with this one provocative thought. When the market sees your newly sorted financial buckets, without the noise and without the flexibility of the past, what true story will your operating profit finally reveal? Thanks so much for joining me on this explainer, and best of luck with your IFRS 18 transition.